Okay, thanks very much. So my name's Shai Hill, and I'm the CEO here in Integrum ESG. Harris has already told you what the company does. So I'm going to move straight on to our honoured guests who are joining us, and I'd ask them to introduce themselves personally, briefly, and just summarise what their firms do. So Mike, over to you, please.
Yeah, Mike Carrodus. I'm the CEO of Substantive Research. We started in 2015 and grew rapidly to being the industry's benchmarker in terms of pricing and supply and demand behavior in both investment research and market data analytics. And also have consistently had a keen interest in the regulatory side of both of those markets, especially investment research with our large Unbundling Uncovered events that we run in New York and London each year.
Brilliant. Thank you, Mike. Neil.
Neil Scarth, Principal Frost Consulting. We work with asset managers and asset owners on research and ESG valuation issues, specializing in making these inputs CSA eligible, which hopefully will presage a return to a more sustainable research and ESG funding mechanism responsibly using client money in a transparent fashion.
That is great. Okay, so we're going to get into it now, and we're going to go at quite some pace. And obviously the focus is not just broader research really, but ESG and payment for ESG, but obviously that sits within a broader regulatory context now. So I want to start off with looking at the situation as it is now before we discuss how it's maybe going to change. So Mike, perhaps you could do us all a favour and summarise what the different research payment mechanisms are today and how they've recently changed. UK and Europe, please.
Yeah, okay. So, I mean, actually, you can bring the States to try and give a sort of fairly straightforward brief on this. So if you think about pre-MiFID II and still in the States, people would pay for research with a bundled trade. And so you would have a broker, you would do a trade with them, there would be commission payable on that trade, and the commission that you paid had a portion of it for execution and a portion of it for research. The other way you could, and you still can, pay for research is through a commission sharing agreement, where the assumption isn't that the broker is going to keep the charge within that bundled commission for research, and actually that those portions of payment for research get aggregated into a separate account, which then creates a research budget which you allocate from the bottom up without assuming that anyone's going to keep anything that you've traded with them. So, and then obviously you could pay for research out of your own pocket. That's tricky in the States, where the rules say that things need to be accompanied by a trade. But essentially in the UK, what happened over the last few years is that MiFID II came in and pushed the large asset managers to pay for research out of their own pockets. And so obviously that created a completely different approach to how people budgeted and approached their research spend. There was also the opportunity to carry on passing research costs on to asset owners through an RPA, a research payments account. But certainly the largest asset managers and the majority of the asset management community in Europe did not choose to go down that route because they thought the research payment account structure that the FCA had created was too onerous. And so a combination of this new transparency potentially bringing unwelcome questions from asset owner clients, plus the onerous operational issues being raised by this research payment account structure, meant that the industry went to P&L across Europe. And this is obviously what's rolling back now, because there's been pressure, political and industry-led pressure, to make the ability to pass research costs on, have the asset owner participate in that research provision and its contribution to performance it's easier and more accessible. And so that's obviously what we're going to talk about today.
Okay, so essentially you wouldn't say unbundling is being rolled back to rebundling, but it's basically the idea is in the FCA and in Europe too, it's going to make it a lot easier to charge research costs direct to the client.
Yeah, I mean, in the essence, the FCA were focused on this unbundling side, because through unbundling comes transparency, and that you know that you can go, right, okay, I'm trading with the best people to trade, and the charges that I'm pushing onto our end investor clients are, rigorously, governed and supported. Similarly, on the research side, so that unbundling is one side. That brings transparency, that brings governance. And I think everyone's in favor of those sort of issues. But the next question of who is on the hook for the actual charge for the research payments, that's obviously a wider discussion. And so I think that we'll talk about this later, I'm sure, but the stigma of putting costs onto end investor clients in Europe is receding and being removed. And so
if you want to do that, I'm going to interrupt then. Neil, if you want to be compliant with this new rule, right, it's policy statement 24.9, isn't it, is what the FCA has sort of put out. And if I'm right, it's in effect now. It's in effect now. The European version isn't in effect for a year, I think, until, is it June 2026?
June 26. Although we talked to, for what it's worth, we talked to a lot of local regulators in Europe. They're barely even aware of this. So I think the risk of a manager putting a global process in place, which is consistent with what we know the ESMA rules will be in June, I think is a pretty low risk proposition.
Okay, so yeah, so we're live. What if you want to then ultimately, as Mike would put it, charge the end investor client for the research? What are the compliance hurdles? What are you, for our audience here, what do you actually need to make sure you're doing correctly to be compliant with that new policy statement?
You have to inform the client of what the research charge is on their mandate or strategy. You have to fairly allocate research costs. And I think that this becomes particularly acute when applied to ESG, because obviously in ESG funds, there's a very wide variety of fund outcomes that are imagined, and there's a very wide variety of ESG inputs that are used. So there has to be some way to allocate those ESG inputs, value, and allocate them at the fund level to make them, or strategy level to make them CSA eligible, which is a challenge for some managers.
Okay.
But it's doable. But I'm just saying that's what you have to do.
So just to be then clear, you don't have to go along to your ultimate client, investor client, and say, we would like to start charging you for research. You can just notify them as of 1st of September, you'll be charged, 0.1% of your AUM as for research. Okay.
That's correct.
Okay. So the real challenge is the attribution bit then. That's the real challenge. And the idea of that, what is that regulatory, is basically, if, using ESG as an example, if these guys don't give a damn about ESG, this, that, and the other, they shouldn't be subsidizing these guys who want a sustainable impact fund.
Essentially, basically the quid pro quo is if the regulators are going to make it easier for asset managers to charge asset owners for research in ESG without their consent, the quid pro quo is you can't charge asset owners for inputs that aren't used in the specific product in which they're invested. So if they're not invested in an ESG product, then it's difficult to charge them for ESG inputs, unless there's a risk overlay as in Article 6 or something like that. But it very much gets into what does the fund say it's supposed to do, and who are the investors in that fund.
Okay. And some people would say ESG is not necessarily investment research, right? I get the fact that I'm going to, charge the UBS automotive research to the clients, but load of carbon emission data, I don't think that's permissible. What do you say to that, Neil?
A couple things. One is ESG ratings data aren't data; they're opinions. Just as Morgan Stanley and Goldman Sachs could disagree about the fundamental valuation of Tesla, Sustainalytics, and MSCI might have a different view on the ESG rating. Number one. Secondly, I think that the other test we use, particularly for things like carbon data, and there's a confusion with market data. Market data, Microsoft's trading at $513. There's no debate about that. That's data. There's no debate. Carbon data, I think, is slightly different. I mean, the rule of thumb in the US is if I can buy it on the newsstand, like the Financial Times, I can't use commission for that. If I have a subscription to the New England Journal of Medicine that costs $100,000, clearly that's not in the public domain. Clearly that's meant to benefit investment strategy. So to the degree that complex climate databases are not public and that asset owners have requested managers to use them, I think that would clearly fall within the FCA definition of research in terms of a decision support input.
Okay. Mike, do you think ESG inputs are investment research?
I mean, I think it's what my clients think is what matters, and I think there's a feeling amongst a great deal of them that it very much is. It's used in the investment process, much as Neil's outlining and has outlined. But I think the key question is how they're going to behave with their interpretation and how they feel the FCA is going to interpret it. So it's almost that they have a basic understanding of how they feel about these inputs and how they're contributing and how they're being used, but they're also looking with one eye on how the regulator's behaving. But I think what we've got is a spectrum, and we've got one set of clients that I think are feeling pretty pragmatic about it and going, look, the FCA, this isn't what MiFID II. They want people to take this new optionality. They want them to move across. And so therefore, they're not looking for to put someone on the front cover of the EFT. And so really it's about helping and enabling these people to move across and find benefits and including these costs in what they're going to pass on. And so I think I've got a large set of things like that. But then others who I think are more mindful that they'd like to wait for some sort of guidance or a new interpretation of what research is from the FCA in order to feel really high conviction about what they're going to do and where exactly they're going to delineate, where ESG, alt data, and research tooling and analytics sits.
I get it. I just would say, though, to the degree that many managers are examining how they're going to approach this new optionality as far as investment research is concerned, a natural allied topic is, do we want, as the asset manager, to include ESG in that discussion? And it probably should be at least brought up into that, because in some ways, you might have a more collaborative discussion with the asset owner on ESG topics than perhaps research topics, because both parties want these objectives to be achieved.
Yeah, interesting. I mean, Integrum ESG is going to get regulated, right? FCA is in touch with us. There's a consultation paper on, and the same thing is happening with ESMA. So I suppose what I say is, I was in stockbroking for 20 years and then came out of the regulatory perimeter of the FCA, and we're going back into it. And I say, why are we going back into it? Because the FCA is starting to say you're influencing investment decisions, right? So you should be regulated like a stockbroker's regulated, which I think supports the view that it is. Neil, haven't you engaged with the FCA directly? Haven't you sort of had some correspondence with them again, which where they've indicated
the broad sweep of it is yes, ESG inputs are eligible as research because they're decision support, and obviously I think the regulators and the government in this country have been broadly supportive of ESG objectives. So why would they essentially discriminate against them? Because I think ultimately what has to happen is, I think ESG budgets and fundamental research budgets has to merge is part of the same thing. And many managers historically have been in separate silos, hence Mike's conversation about which ones are part of the data budget as opposed to the research budget. But I think all of this has to come together. Also from a regulatory point of view, as you know, the SEC has charged managers and fined them lots of money for overstating ESG integration at the fund level. PS 2316 has a lot of stuff in there about resourcing at the fund level, and it all comes down to what this fund says it does on the tin. So can we match that up with the resources that are required to run this strategy, particularly for long tail strategies like climate? I think it's possible to put this together in such a way that it makes a very convincing both regulatory and client case.
Okay, thanks for that. Now, before we'll obviously need to talk about how things might change in payment, but just before we go on to the shift, let's just have a look on ESG inputs at the status quo. Some of our clients charge it to the research budget. Some of them charge it to the data budget. Let's start with Mike. I mean, in terms of your clients, you've got a broad client base. Do you think most are charging it to data or research budget?
I think at the moment, certainly what we see is most are charging it into their market data budget, and therefore it's on both sides of the Atlantic. For a lot of firms, it's coming out of their P&L. And obviously there are two things going on there. In Europe, you've got pressure on research budgets, but also globally, you've got market data budgets going up enormously, which we've communicated a lot publicly. And so something's got to give, and this could be a very important potential shift because if you look at index costs, ratings costs, et cetera, terminals, whatever, everything is going up fast in those worlds. And so if you can decouple the ESG element and have it go into the CSA and be part of that research budget, you've created a very different dynamic on how people are going to approach it, how they're going to use it, and how they're going to invest in it.
Yeah. Okay.
One of the things to point out for your listeners, ESG and research costs are 2-3 basis points against 700 basis point returns. So the cost to asset owners are completely dwarfed by the variance in fund returns. So these are not immense amounts of cost we're talking about transferring to asset owners, just so people understand that.
And that's a very good that's a very good context. But I want you to just comment on Mike's experience. He's saying that most of Substantive's clients are paying for ESG inputs out of a data budget, currently not a research budget. Is that what Frost Consulting is seeing?
We find it's a mix. I mean, typically we tend to encourage people to put the ESG costs into the research budget because depending upon how the fund is constituted, we think this is the better long-term answer and more sustainable because obviously asset owners can fund that.
And no particular in terms of that approach, data or research, no particular difference, let's say, between, I don't know, a small hedge fund or a large traditional long only?
I have no particular view. Mike, I think you had more thoughts on that?
Yeah, I mean, I think hedge funds, it depends on which jurisdiction they're in, but they may be a little bit more varied in where those inputs go. And in fact, a hedge fund often will see a lot of things as more interchangeable. But obviously, in the end, what we're talking about is who's funding these inputs. So I would say, yes, there's probably a higher incidence of data that gets funded by the asset owner from a hedge fund perspective than a long only, but
and research as well.
And research.
Yeah, interesting. Okay, so let's look at how things are changing. Might change further, please, gentlemen. Who's actually moving back to using client money to pay for research, Neil? I mean, I've been to your conferences and people are talking about it in the side rooms. They've been talking about it for over 12 months. I'm not really seeing it. Are you actually seeing this shift starting?
We've worked with multiple clients who have done this successfully, but once again, as we've noted many times, they're tending not to issue press releases because there's no commercial advantage in doing that. And I think some of the survey work, as Mike has done, has illustrated that many people are moving that direction. I think the other thing is, with this regulatory liberalization, I think the shareholders of asset managers would expect the executive committees to at least do the analysis on this because it's a lot of money. And so they at least have to go down the road. And I think as well, there are elements of the government and regulators that want this to happen for the good of the UK capital market. So multiple governments and multiple departments would really like to see this happen, I believe.
Okay, interesting. So they are moving to it. You're seeing a number of your clients moving towards charging it to the clients. How's the client discussion going?
Yeah, so I mean, I would say that the case studies we have at the moment are from smaller firms. How much you want to extrapolate that through to when the larger firms participate in this is up for debate. But the friction has been pretty low or even non-existent in a lot of cases. So that is a very positive early set of indicators from the canaries in the coal mine. And obviously then there's a bigger group trying to get things done before the end of this calendar year, and then a even bigger group looking at before the end of H1 2026. I mean, from our work, if you look at, we surveyed a portion of our client base, 87% of respondents predict that at least half of all research budgets will become client funded within the next 2 years. And 97% of respondents said that the new requirements were workable versus 40% previously when we surveyed a few months before. And so the changes, the FCA has listened. They've made it clear that the strategy.
Sorry, that second stat is very dramatic. Less than half think it's workable, almost everyone thinks it's workable. Please, what accounts for that change, Mike?
Well, I think the clarification that strategy level budgets are acceptable. That doesn't mean that everyone's going to want to do strategy level budgets. They can do fund level budgeting, and many do, and many will. But there was certainly a pushback on being required to. So
by strategy level for our audience, please.
Well, there's lots of different levels that you could have a research budget, and the idea is, what's the FCA is trying to achieve? The FCA is trying to achieve that, there's a pension fund over here investing in a particular type of fund, and it's getting charged for the research. What it doesn't want that pension fund being able to complain about is the fact that it has subsidized other research that's being used for other asset owners assets without those people being on the hook for that charge. So the question is the money I'm paying you for you to be able to get research benefiting my assets? So, but the question is, at what level do you need and have to? I mean, there's different questions. Should you have to, what's the FCA saying? But the clarification was that instead of the budget having to be done at a fund level, that you could do it at a strategy level, which means that could be lots of different funds that are part of an overarching strategy. And there were a lot of very large firms that felt like the administration of a fund level budget was prohibitive to them being motivated to make the move across, and they communicated that very clearly to the FCA. And so the FCA listened, made the changes, and I think that is by far and above, that is the change that created the difference in that particular statistic.
Got it. Thank you. Neil, what are you seeing? Like, is it more smaller firms that are the first movers?
Yes. Although we know some very large firms who are very much caught up in the weeds of moving in that direction. I think
absolutely
mobilization means war. To come back to your earlier point on client communication, if you have a client communication risk mitigation strategy is important. If you do this in a clever way, your chances of getting resistance from clients are low. And some of the clients we've worked with, what we found is when asset owners get the email saying we're going to put this minor charge, the 95% of asset owners don't even open the email. Yet the perception is there's going to be a wholesale revolt. That has not been our experience. And I think once again, coming back to the strategy level, ESG makes it a little more complicated because some ESG funds are pretty specific, and they may lend themselves less to strategy aggregation than some other fundamental funds.
Okay. I mean, I think in the end, this stuff is about common sense. If you tell me that you're going to pass on some costs to me, I'm going to ask you, am I getting value for money? Are you governing that cost? And is it creating outcomes that are beneficial for me? So, one of the reasons we have a price benchmarking business is if I give you some money and you spend it, are you spending it in a way that's intelligent and understands what market rates are? And so, the FCA put that clause in about ensure the amount of research charges to clients is reasonable compared with those for comparable services, and talked about price benchmarking. I mean, for me, you don't really have to get hung up on the minutiae of what potential requirements could be, as long as you stay with that fundamental ethos that are we investing in research that's benefiting our client base, and have we aggregated at an appropriate level? And as long as you stick with that, you're going to be fine. And I think that that putting in ESG, our data, and other types of research-driven inputs is completely commensurate with that.
Okay, but when I talk to some people at big firms, I won't mention them, they said, well, look, we did this whole communication over MiFID II, saying we will no longer be charging you for research. We have an option to do so, but they span the decision. They didn't say, oh, RPAs are unworkable, that's why we did it. They said, we're taking the cost onto ourselves, we don't want to charge you, and we've got the scale to manage that. And they made a big hoo-ha and turned it into a virtue. And they say, we can't go back on that. Our clients will go mental, right? Overall. You guys are both saying the same thing, which is the clients won't go mental at all. They hardly bat an eye.
Some clients may push back, but let's face it. 95% of U.S. managers use P&L in Europe and charge U.S. asset owner clients. Yeah. So how do you square that circle? And actually, one of the interesting things in this conversation we've had with the pension regulator is the Council of Institutional Investors in the U.S., which is a big lobby group of U.S. pension funds, and the CFA Institute wrote to the SEC and said, we're okay with managers using our money for research as long as they tell us how much it is on a per mandate level and there's no cross-subsidization, which is broadly consistent with the new UK rules. So one of the questions in Europe, how come U.S. asset owners are okay with this? and European asset owners aren't. It's because US asset owners understand that the research cost is very small relative to the range of returns. And I think to the degree that the regulators wanted to create more of a level playing field, hopefully we're all moving in the same direction.
Yeah, but Shai, I mean, to your point, was there a bunch of money being wasted in research before MiFID II? Yes, there was. And so there was an industry shift, both sides of the Atlantic. We tracked it on both sides. And so there's been a recalibration of supply and demand in research over the last few years. The question is, has it gone too far? And is it going to create consequences that are obviously unintended and negative for the industry? And so that's where we're at now. But the point was that, yes, there was something to fix. Maybe this strange roller coaster is the only way we could get to the right place at the end, because I'm aware there's still a portion of my client base that don't like the idea of returning to client-funded research. They felt it was the right thing to go P&L. They like the transparency and the simplicity of it. But as this becomes a wider industry move, they may feel like they have to go in order to remain competitive. And so I think the narrative around this and the approach around it is really important to understand that, there's a lot of different firms in a lot of different places. But in the end, when you hit tipping points, momentum is created and an industry will behave accordingly.
Why is it the small guys leading? That's unusual, right? It's normally the small guys have the less confidence and they want to see one of the big household names move first. What you're telling me is the reverse is happening. Why?
They have a greater financial need.
Yeah. Just the margin pressure, just like they've had
smaller companies, the research budget is a bigger part of their P&L. They're more sensitive to market fluctuation when it comes to those research budgets and the amount of information they're able to get.
Yeah, absolutely.
Understood. Do you think there's any risk that one of the big guys, especially if they're largely US money, I don't know, I'm going to name BlackRock, not that I know what they're doing, right? But just as an example of a household name in UK and Europe, but actually most of their money is stateside, that they would try to leverage some strategic advantage by saying, actually, it suits us, this disconnect between the US and Europe suits us fine. We'll carry on taking the research costs on P&L, and we'll make a big virtuous song and dance about it. Is there any risk of that happening, strategic?
That's what happened in 2018. They took this created this whole momentum towards P&L. I think at the end of the day, if they want to do that, I think that what's going to create an incentive for them, if everybody else moves back and we have 3 or 4 large US managers who are still using P&L, they're going to say, why are we doing this? We've worked with multiple managers in the US who've gone from P&L back to client money because there wasn't any client advantage at the end of the day.
Yeah, in the end, there's no cliff edge, right? We had a cliff edge with MiFID II. There's no cliff edge with where we are right now. So in the end, what's going to happen is everyone's going to move at the pace that's appropriate to them and their needs and their culture and their business model and their client bases. So what you'll find is this, what we've been tracking is this gradual shift of sentiment and approach, right from, are you kidding? Like you said, this has all gone one way. How are we going to go the other way? But what we've been tracking over the last year and a half, especially, is this gradual move and hitting tipping points where now we're very confident that this is an industry move. And we just watch we're kind of like technical analysts watching the price action. We're just watching firms coming to different conclusions now for lots of different reasons. But the fact is that ship has sailed that you're describing. I mean, this is now there's a significant portion of the market that will have moved to client-funded research budgets by the end of 2026. We think it'll be something like half to 2/3, and then there'll be ones that are 27, 2028, and some never.
Okay.
The thing is that not staking with P&L is not risk free. If research prices go up or there's a bear market, you have substantial risks. So that it's not necessarily a risk free option.
Yeah, interesting. We'll come on to that. But the bear market scenario. But I just want to bring it a little bit tighter into ESG specific. When we talk often to, shall we say, buy-side counterparts, head of ESG and stuff like that, they grumble about their budget and how it's it's been paused now after years of growth and it's still very small relative to research budgets. And when you talk about issues like RPAs, CSAs, I'm going to be very broad, not all, they don't know what you're talking about, right? They know everything about the 15 categories of scope 3 carbon emissions. They don't know what a CSA is. Do you think that's going to be a challenge for ESG providers that their main counterparts just are not anywhere close to the weeds on how they might actually charge this to the end client?
I think it's a challenge because they think they're doing very important work that transcends economics. But the CFO is the linchpin in this. This is where the rubber meets the road. And I mean, clearly, that the educational process has to be with those ESG professionals, but also with the CFOs of the firm, because a lot of firms, I mean, many managers don't know that ESG inputs are qualify as research and actually can be made CSA eligible. So this is an industry educational effort.
Yeah, and I would say, when it comes to how things unfold and the sort of specialization of the ESG departments, etc. In the end, moving to joint payments is a organization-wide initiative. It brings in your operations, finance, client-facing, compliance, legal, etc. It's everybody. Everybody's going to have to get involved to do this change, which is why it's been gradual. But the fact is, once you've done that, once you've mobilized all of that and you're doing it, you're going to reap the benefits. So there's no way that they're just going to, at that point, then just forget about ESG inputs and whether there's a benefit to moving those into the CSA. It will just become part of the process. So whether those people decide to inform themselves or not, they will be approached if the wider organization is moving to joint payments.
Got it. You agree with that, Neil?
Yeah, I mean, the conversation we have with clients all the time is the point of departure is always, should we go back to client money for research? And I always add, at this point, please take into account ESG as well. Why would you not, take a holistic view of this? Because they're all decision inputs, the standard argument. So I think there is still a bit of education to do around that. But
yeah, I mean, I'd agree with that like a while ago, but I would just say that the CSA eligibility is such a hot topic right now, whizzing through C-suites that that are looking at this, that I would hope that we're further down the line.
Yeah. The other thing is, once again, it's a more collaborative conversation with the asset owner because they've outsourced this to managers. They want these objectives to be achieved. It's a good place to start the conversation.
I mean, from what you've said, by the way, I'm now stepping up to a higher level, just the policy, the regulator, the government. You could say, I'm being very crude, MiFID 2 is about taking cost out, right? The FCA put MiFID 2 in, everyone warned them about unintended consequences, but then they did a big lap of honor before it even settled, saying we've saved the widows and orphans hundreds of millions of research costs. It sounds like there's something very different going on policy-wise, which is we want to put more money back into the capital markets, right? Back into research teams and all the boffins who analyze companies. So that would mean we actually want payments to go up, and if you're going to try and charge it to the client so you can spend a bit more, we're not going to try and trip you up. Is that right, Neil?
I think that's fair. And the other side of this is the whole pension reform in the UK. The Mansion House Compact, 17 large DC funds putting 10% of their AUM into unlisted equities, including listed equities on AIM and Aquis. What we've said to the pension regulator is, look, if pension funds are unwilling to fund manager research budgets, there will be no information on these companies. So, there's also an employer's pension pact where a whole bunch of fund managers and other large UK companies have said, we're going to pick pension products based on the highest net return, not the lowest cost. So there's a huge government-wide and pension-wide, system-wide effort to re-equitize the market by getting people to buy something other than index funds. So yes, costs will have to rise, but the whole thing about the value for money framework of the pension regulator is it's not just about cost, it's about what is the return on this product, not just the cost of it. So, it's a huge step change in trying to change the attitude of asset owners. So if in the value for money framework, the pension regulator says we advise that pension funds should fund manager research budgets if they're PS 24/9 compliant, if they're transparent, and if they're benchmarked, that will have a huge impact on that asset owner, asset manager conversation in this country as a whole. So there's a lot of stuff happening behind the scenes that is moving in this direction.
At this stage, I think it's important also to note that the FCA hasn't said that it's done anything wrong. Its policy statement is basically outlining, but says that it was good, but that looking forward, there are risks from a P&L driven market, and that maybe the payment optionality was addressing those risks, and the sort of the stimulus about pushing along UK PLC. But the fact remains that however this plays out, a lot of gates have to go down for this rosy scenario of, okay, it's now CSAs, budgets are more flexible, potentially, yes, depending on how the client base behaves. And you can justify those changes. And then that's going to stimulate greater coverage and better outcomes. I can see it in some areas, stimulating SME research, which was one of the big swords that pushed this along, I think is interesting. But I think the challenge there is without a change in behavior in terms of asset owner demand, then it's very hard to see all these new research inputs coming up to meet that. And so what I think is really fundamental and is important that there has been a focus on this is how are pension funds behaving, how are they going to invest, and the wider discussion about how they should and how they can keep their fiduciary duty, but also be aware of some of the pushes that they should be more participating more in the domestic economy. I think there's a lot there, and so, but for the purpose of ESG, I think that it's a lot simpler. This can benefit ESG very straightforwardly.
And here, asset owners, UK asset owners, put this statement on climate stewardship. There's all sorts of UK and EU asset owner organizations which have been very vocal about maintaining the importance of ESG inputs. And obviously, given the political pressures in the US, a lot of big US managers have had to quit NZAM and Climate 100. There have been some major mandate shifts away from US managers towards UK and EU ESG managers. What we're saying to people is, gee, this is a great opportunity for these EU and UK specialist managers, but they have to make sure that those budgets are sustainable over the long term in order to deliver on this.
So Neil, talk to me about this. Mike's referred to the P&L risks, and I think you've said in the past it's maybe particularly pertinent to ESG because that is a very long time frame risk and it needs to be decoupled from market cycles. Just summarize that argument for our audience, please.
Bottom line is we're trying to fund carbon neutrality in 2050. The average length of a financial market cycle is maybe 8 years. So that means that there are going to be downdrafts in which the profitability of asset managers will drop precipitously, which will imperil their ability to maintain these programs. So basically, unless we change the funding system, ESG objectives can't be achieved unless one of three things happens. Either A, governments fund the entire transition with no private capital. B, asset managers running ESG products become nonprofit social enterprises. Or C, we find a mechanism which will eliminate market volatility on a 25-year view, none of which is likely to happen. So this is why I think the pension regulators is involved in this, because they understand that these objectives are incompatible with the funding mechanism. We have to change this. And that's the basis of a collaborative discussion. We've come up with an ESG cost plus model, which allows asset managers to underwrite asset owners to underwrite asset manager research and ESG budgets to take the market risk out, but still save money over the course of the cycle. So there's many ways in which managers and asset owners can collaborate and lengthen investment mandates to make sure these objectives are achieved. But it can't happen if you're running on this P&L model where you're determining the profitability of the company 25 years ahead of the objective. It just won't work.
Does the pension regulator get that?
Absolutely, and that's why they're on this call.
Oh, okay.
They really do. They really do.
Does the FCA get that?
Yeah, yes, we had this discussion. Yes, they're aware. They're certainly aware of it.
Okay, that's very interesting. So I'm now going to talk a little bit about your firms. So I'm going to ask you to give our audience a free sample of your brilliant advice. So there are lots of people on this call are going to thinking, okay, I would really like to charge my clients for ESG costs, for research costs more widely. What you have both said loud and clear, I think, is going to reassure them that the thing that they're probably most scared about, which is their clients are going to throw all the toys out the pram, ain't going to happen. Key takeaway, I think, is Neil saying they won't even open the email when you tell them you're going to start charging them. So the bigger challenge is, then probably a lot of the audience is thinking is, okay, so if I've got it, the big challenge is going to be attributing it correctly so no one can accuse me of making them cross-subsidize someone. And secondly, showing value for money. So Mike, give a couple of freebies before people employ your firm and say, look, how should they think about demonstrating value for money and no cross-subsidization?
I mean, we started price benchmarking agnostic of how people were funding their research, and obviously we do it in data as well. We just think that it's strange not to know what a market rate is for you to decide whether you want to reward above or below that rate. And so therefore apples to apples price benchmarking is key to making an informed decision and understanding what your payments represent in terms of what you should be expecting in return for those payments. And so obviously that's important if you're a P&L funding organization, because your CFO wants to know that you're paying appropriately, but it becomes even more important if you're passing those costs on and you've got to reassure potentially your end investor base and as well as the regulator that you're doing everything in your power to get value for money for what you're spending. And a very pragmatic, straightforward way of doing that is understanding what the market rate is for a very specific footprint and use case. With, you know, and these things are complex. We spend a lot of time doing them, but in the end, you get a simple answer out of a very laborious process on our side. That gives you confidence that you understand what you're paying. And then if you get any questions, the point is you've got to bulletproof yourself. I mean, I'm not going to be on the hook if anyone has a complete nightmare, because you've said, you know, we're saying it's all going to be fine. Well, it seems like the early indicators are all going to be fine, but I mean, I'm sure there are people on this call listening to this call who know that there's a couple of their clients that are going to be on the phone or send an email. And we think it's just really important for people to have their armor plating in terms of governance, to be able to say, no, we've benchmarked this market. We understand what our prices represent. We know that we're getting value for money, and where we are paying above market rates, we made a conscious decision to do that because of certain strategic motivations that we've employed on that behalf. So, but for me, I think that what we do is necessary regardless.
Mike, one thing I can tell you is ESG pricing is all over the place. I think, you know, the price, like equity research has come in over the last 4 years post MiFID. The ESG inputs, the pricing spread's massive, right?
No, differential pricing is a huge issue in data, and across the market. But I think especially in ESG alternative data and some of the core market data sides, we see that the enormous ranges of pricing for identical use cases is extremely prevalent, and therefore having some transparency to that. The regulator had a look at this on the market data side a year and a half ago, and then decided not to do anything, even though it wrote a wonderful paper on how broken everything was. And so, you know, you've got to have a way of understanding what you're doing, and that helps you explain to others. And in the end, that's what all of this is about. Are you going to feel okay about explaining something to someone else and knowing that you're in good shape to do so? And so, you know, that's obviously what we do on the price benchmarking side.
You kind of addressed the value for money thing very clearly. Over to Neil. How about the individuals listening who think, when I'm asked, are you is my money cross-subsidizing these people invested in ESG focused impact accounts, etc.? How should they go about reassuring? Give us just a few freebies. How do they go about reassuring their clients that they're not using their money to cross-subsidize other investors?
Key point is just creating alignment. And the other complication is the same research service or ESG service could be worth vastly different amounts to different strategies, depending upon what that strategy does for a living. That's why we have an architecture that values and allocates these costs based on what the fund outcome actually is. And obviously, if the fund outcome of the anti-ESG fund is whatever it is not going to use any ESG inputs, there are going to be ESG and other funds that will use them in different proportions. So it's a matter of understanding what products are needed in that, creating alignment, and then basically to create a valuation. So what you want to have happen is the research budget should reflect the investment process that has been agreed with the asset owner, so they can see how this spending directly supports their return objectives, and in some cases, if for ESG funds, their non-return or social objectives. How do we create the alignment? And once that's done, it makes the conversation much easier with the client, and it's giving client service people that data to have the conversation with the client.
Interesting. I want to leave some time for Q&A, so I'm going to ask my final question, which is forecast time. So I want you two gentlemen, please, to look forward to Christmas 2026. And I want you to tell me what each of you thinks the percentage of asset managers who are charging investment research to their clients will be, and the percentage, more specifically, charging the cost of research, ESG inputs, charging the cost of ESG inputs, not overall research, to client money.
So I would say I think something around, in terms of assets under management, 60%. So probably a lower number in terms of number of asset managers, but certainly in terms of AUM, I think will be the majority. And for research, and then in terms of ESG, I think it will lag that, but not by too much.
Okay. Well, before I ask Neil, just one little question there. You say basically the percentage of AUM will be bigger than the percentage of asset managers. But if it's the smaller guys who are under the most margin pressure, shouldn't the reverse be true? Shouldn't
I think it's a three-step process. So I think what you get is you get the smaller people going first, and then everybody watching, then thinking, oh, it's okay. Then you get this big shift of big firms, and then because there are still a lot of small firms that are really struggling with this because the client conversation could be potentially more problematic, and their client-facing people are saying just can't do it, and because they don't have the aligning global processes narrative behind them as an argument. So there are definitely people in different situations.
That makes sense. Neil, 2 numbers, please.
Yeah, I think this is not going to be a 50-50 outcome. I think once the tide turns, you will see most managers going back to funding research by client money. Most of them want to do it. On the ESG side, what I will say is I think the most successful ESG asset managers will be the ones who do this, because they will have explained and come to an agreement with their client that they have to collaboratively fund these long-term ESG and stewardship budgets in order to achieve their objectives. So they will be the real winners out of this, because they will develop that close relationship with the asset owner and foster this recognition that they have to work together in order for these objectives to be achieved. And the US managers who have had to step back from doing this will do less well.
So no lag, like Mike sees, no lag between.
I think there could be an educational lag, but particularly for the ESG specialist managers, that's all they do. We know who they are. They have a very, very particular relationship with those asset owners. They have very specific ESG and stewardship objectives that they want achieved. So those types of managers can work very closely with their asset owners, say, how can we achieve this together and hedge the market volatility out of this? And there are ways to do it.
So when Mike said, 60%, you said it'll just go, right? It'll go. We're past the tipping point. It'll go. I mean, what are you saying? Even by the Christmas 2026, are you talking 90%?
I mean, the vast majority. I don't know many people who really don't want to do this, and even people who claim they don't want to do this may reevaluate if the market context changes. Because once again, staying with P&L if everybody else moves is not a risk-free option.
Yeah, I mean, my brief is based on the fact that you start doing something and you realize it's 10 steps, not one. And then, someone isn't pulling their weight in your internal legal department and 3 months goes by and you're in 2027 before you know it. So I agree that it's an industry move. I'm just a bit pessimistic about some firms' ability to move at pace.
Got it. This has been excellent. You've answered all my questions and you've answered them very directly. We've got 10 minutes left. I'm going to call in my esteemed colleague Harish to. Are there any questions from the audience, Harish?
There are quite a few. As I predicted, we're most likely not going to have the chance to answer all of these questions, but I will pick out a few for you guys all to answer. Starting with Mike Terrell asked, picking up on Neil's comments about the importance of putting climate-related research on an economically sustainable basis and Shai's thoughts on lack of awareness of ESG heads, is there any prospect that regulators might force the issue and act to require asset managers to explicitly state how they pay for ESG data, ratings, and research?
Before they answer that, Harish, I'm going to have to correct you. It's because he's an industry legend. It's Mike Tyrrell.
Mike Tyrrell, my apologies.
Anyway, that's the question. And Mike, you go first, please.
So, sorry. So the question is, are they going to require? I don't think the FCA likes to require people to do many things outside of extremely well-considered big picture stuff. So, that takes a long time to get to a conclusion on. So I would say that there won't be a requirement to do so, but there could well be guidance that aligns well with it, but I don't think they'll force people to. Just because I'm thinking about things like independent research, where there was a push to sort of for the FCA from independent research providers to say you should put it into requirements that you delineate and you declare your independent research to asset owners, and the FCA looked at that and specifically decided not to put it in. Wasn't that they weren't sympathetic with it, but I think they just shy away from requiring in that sort of area. They prefer the outcomes principle based kind of guidance.
Got it. Neil?
I think the pension regulator is in a different position because they're about to opine on value for money for UK pension funds. So do UK pension funds maximize the value for money they're getting from asset managers by denying them 2 basis points of research and ESG costs? They are in a position to say, we think it's in the best interest of pension beneficiaries that pension funds will support transparent, benchmarked manager ESG and research budgets because we all want these objectives to be achieved. So that they're in a different position than the FCA on this is my view. And certainly myself and others have suggested that they go down this road because once again, there's been a frustration that pension funds have sort of not pulled their weight in the UK. They haven't contributed to growth capital. There's been a de-equitization of the market. They have to participate. If they don't participate, given their long duration and low research costs, there is no way these objectives can be achieved without their participation.
Yeah, I think with the FCA is where you've got to pick your battles. I mean, people have gone back to the Bank of England. They've done a lot of work on all of this. They're just about still looking at corporate access and CSA eligibility of, data and other inputs. I think so. There's a couple of things that you can get them to focus on and try and get a good outcome on. Much more than that might be a bit ambitious.
Okay, Harish.
Next question from Graham Sinclair. How would an investment client strip out ESG-based analysis if they did not want to pay for it? Climate is a meta theme showing up in different ways in different situations. For example, spiking food costs locally after extreme weather, or collapsing infrastructure in a location, melting or drowning. How would an investment opinion client strip out the ESG advantage from covering the impacts and costs?
I mean, my approach to that is, the way that they would do it with other inputs, basically is right. Is this provider CSA eligible or not, given what we consume from them? And if and who knows, we could end up like in the States where people are CSAing 2/3 of their Bloomberg terminal, but not the last third. So I think there's a number of different outcomes potentially on that, but I think, yeah, I mean, are you going to strip out the 5 conversations you had with a bulge bracket broker on ESG and CSA it that bit because it's part of your ESG versus what maybe you're paying hard for that broker otherwise? I don't know. You're not. You're going to have a process that's going to cover a lot of stuff. So I don't think they'll want to look at anything at that granular a basis. They will categorize providers based on what they're consuming for those providers and then decide whether they're going to pay them out of the CSA or not.
I mean, it's client driven. His client says, I don't want to own tobacco stocks, and we run the same global portfolio without tobacco stocks. There may be some US managers who say, we don't want to pay for ESG stuff.
Sure.
We can do that. I agree it should apply to all portfolios, but not all clients share that view, and it has to be ultimately client driven.
That's great. Thank you for that. Harish, next question.
Shai, there's a question for you on ESG ratings being opinions. Shai, from your experience, is this what your clients view as? And how many of your manager clients are currently charging the cost of their Integrum subscription to their fund?
The cost, the last bit first, charging the cost of the Integrum subscription to the fund would be less than 25%, right? Somewhere between 10 and 25%. So it is low. In terms of the first bit is, yes, they would see not just the actual rating, but also the highlighting of ESG risks as analytical, as a type of research. But I think that they would not see, let's say, carbon data, weight data, gender diversity stats extracted from the company's own disclosures as investment research. I think they would see the analysis as maybe sustainable, just the raw data, perhaps not. But if it's packaged together, as it typically is from us and our competitors, here's the opinion and here's all the raw data you want underneath it, they do see the overall package as chargeable to clients? Yes, under the new policy statement.
The final question. Oh,
It says,
sorry.
sorry, as I answer that question, it was a question to me, whoever it was, but I don't know if Mike and Neil want to opine or differ from what I've said on that. No. Okay, sorry, go ahead, Harish.
Yeah, so the final question we're going to ask today, how can managers value ESG inputs when traditional research MiFID II style valuation methods, including counting documents and interactions from investment banks, don't seem relevant?
Great question. You need a different approach. I mean, you can't count documents to establish the value of a climate database to an impact fund. We have an ESG native architecture that views and values these services based on the lens of what the fund is trying to achieve. So it's really this alignment it has to be, because I can have an Article 6 fund with a minor risk ESG risk overlay. I can have an Article 9 fund that just is a horrendous, huge consumer of different types of ESG inputs. So this is where the fund specificity really comes to the fore. And once again, the manager's ability to do that will have a major bearing on their ability to convince or to collaboratively work with the asset owner to jointly fund this so this works, because otherwise it won't.
Yeah,
so this is a critical thing to be able to do.
Yeah, I mean, my perspective on that is, if you look at our client base, they value research in a million different ways. Yes, there's interactions that come in. Yes, there's voting that the portfolio managers do that are more qualitative versus the quantitative counting of things. But actually, there's lots of different nuances within that. And I think every building has their own way of coming up with a way of justifying. Depends how big you are, and it depends on how you culturally behave. So I don't think I don't think that's a I don't think that's something that the asset managers are going to struggle to come up with their own answer and who they want to work with, how they want to do it, how they want to structure it. This stuff just comes out very organically, I think. And obviously, we're all part of these solutions.
Okay, thank you very much, Harish.
I think we are out of time for any of the remaining questions. As I said, we will respond via email after this call. I just want to thank Shai, Neil, and Mike for their brilliant inputs during this conversation. If you do have any other questions, please do get in touch with us via email, and we will be circulating the recording of this webinar following the meeting ending. So thank you guys again for joining.
Thanks a lot. Thanks for the invitation.
Thank you very much.
Okay, thanks. Bye.
Cheers.
Thanks.